What if a Canadian employee moves to a different province? When a Canadian employee moves to a different province, your payroll and HR obligations do not stay where they were. The law follows the employee's new place of work. For a US company, that means a simple personal move can quietly change income tax rates, social contributions, minimum wage rules, overtime standards, and even workers' compensation coverage. If you treat the move as a personal detail instead of a legal change, you end up with mismatched pay and reporting. Why the employee's province matters. Canadian rules for employment standards and certain payroll items are provincial. The province where the employee actually performs the work is usually the one that applies, regardless of where your entity is registered or where the manager sits. That province sets minimum wage, overtime triggers, public holiday rules, vacation minimums, and some payroll levies. So when an employee moves from one province to another and keeps working remotely, the home base for those rules shifts. Income tax and payroll set up after a move. Provincial income tax is collected through the same payroll system as federal tax, but the rates and credits differ by province. When an employee moves, you need to update their province in your payroll setup so that provincial income tax is withheld correctly going forward. If they move into or out of Quebec, the changes are even bigger because Quebec runs its own tax system and pension plan alongside the federal one. Treating a Quebec move as just another change of address will almost certainly produce wrong deductions. CPP, QPP, and EI considerations. Most provinces use the Canada Pension Plan, but Quebec has the Quebec Pension Plan instead. An employee moving from Ontario to Quebec or the other way around may have to switch between these systems. Employment insurance remains federal, but insurable earnings and reporting still depend on accurate provincial coding. If your payroll system keeps the old province code after a move, contributions may go into the wrong bucket, and year-end slips will not reflect the employee's real situation. Employment standards and compensation floors. Employment standards governing minimum wage, overtime, rest periods, and vacation pay are set by each province. When an employee moves, you have to check whether their compensation still meets or exceeds the minimums in the new province. A salary that was above minimum wage on an equivalent hourly basis in one province might fall uncomfortably close to the floor in another. Overtime rules can differ as well, meaning the same schedule could now trigger overtime that was not required before. Workers' compensation and other provincial programs. Workers' compensation coverage is also provincial. If you are registered with one provincial board because you first hired in that province, you may need to open an account with the board in the employee's new province. Premiums, rate classes, and reporting deadlines can all change. Some provinces also have employer payroll levies, such as health or training taxes, which may apply only once your payroll in that province crosses a threshold. When an employee moves, you should re-evaluate whether these levies now apply or no longer apply. Updating contracts, policies, and internal records. From an HR perspective, a move between provinces is significant enough that it should be documented. At a minimum, you should update the employee's address and work location in your HR system and payroll records. In many cases, it makes sense to issue a short addendum to the employment agreement confirming the new province of work and stating that provincial employment standards in that province now govern. Policies that refer to local holidays, leaves, and benefits may need to be adjusted or clarified for that employee. Handling mid-year moves and year-end reporting. If an employee works part of the year in one province and the rest in another, year-end reporting must reflect that. Payroll systems can track province of employment by pay period so that the T4 shows the correct codes. For the employee, this sometimes produces a more complicated personal tax return, but that is better than trying to pretend the move did not happen. Your responsibility is to make sure payroll records match where the work was actually done throughout the year. Having a clear relocation policy? To avoid scrambling, it helps to have a simple policy on cross-provincial moves. That policy can cover whether employees are allowed to relocate freely, which provinces you are prepared to support from a payroll and legal standpoint, and what notice employees must give before moving. In some cases, you may decide not to support moves into particularly complex jurisdictions until you are ready to handle them. Being upfront about that is better than silently allowing a move and then struggling to catch up. Final thoughts. When a Canadian employee moves to a different province, your obligations move with them. Income tax rates, CPP or QPP, employment standards, workers' compensation, and payroll levies may all change. The move is not just a line in the HR file. It is a trigger for a full review of how you pay and protect that employee. If you build a simple process to capture relocation requests, update payroll settings, and revisit minimum standards whenever someone changes provinces, cross-country moves become manageable instead of risky. If you want a practical checklist for what to update each time a Canadian employee relocates, you can explore more guidance at www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.